Hello everyone, welcome to our Facebook Live event, our Ask Us Anything session again. This month we have a very special guest, which is the CEO of Equitiestracker.com, Alvin Vong. I met Alvin a few weeks ago, and I have to say he's one of the most learned and knowledgeable investors I know about the Malaysian stock market. So I see him as my Bursa guru. And let's welcome Alvin. Hello, Alvin. How are you?
Hey, Stanley. Thanks for having me on Value Invest Asia, and thank you for the praises.
Yeah, definitely. So, you guys, if you have any question for Alvin, you know, we have compiled a list of questions from him from all of you previously last few weeks, and but if you still have other questions, you can just comment down below. Say hi to Alvin when you're logged on. Alvin actually told me that Equitiestracker gonna give you a very special gift for everyone at the end of this session. So stay tuned until the end, and Alvin will share with us what is the special gift. So the topic for today is the 6 category of stocks all investors should know, and I think this 6 categories is something that Equitiestracker and Alvin has sort of created. Maybe you want to give us a rundown on what the 6 categories are, and maybe we go in detail on each one of them. Yeah.
Sure. Thanks, Stanley. So one of the things we had issues with when we were trying to craft out a portfolio was, a lot of us will go through, should I put in terms of sectorial, like should I do technology, should I do consumer, and so on and so forth. But as we dug through and we start realizing, actually within sectors itself, you can actually differentiate very distinctively the types of stocks that actually sit within the same sector. So the six categories. So we decided to actually let's start categorizing these companies because each of them will give you different risk profiles. So the 6. I just read out the 6 to you. The first one right on the top is what we call investment grade stocks.
Okay.
Right. Investment grade stocks. Our definition is very simple. They are more than 10 years old. They're at least 10-year-old companies. So we go by age. Number 2. They have been continuously profitable for at least the last 10 years, yep. Right? And they have continuously been paying dividends continuously for the last 10 years minimum, and they must have had at least 10 years of positive operating cash flow. So then you get an idea that investment grade stocks are the lower risk guys, mm-hmm. Right? Then your next level, actually, you go down one step, would be what we call emerging grade stocks.
Right.
Okay. Now, emerging grade stocks are stocks that are at least 4 to 5 years old and less than 10 years old. And they lie sort of between this area where they are emerging to become investment grade stocks. So they're on their way to maturity, right? And if you go down one level, then we realize that we have emerging grade stocks that give us a nice, nice potential to move to investment grade stocks. The third level is actually what we call cyclical stocks, right? So cyclical stocks go up and down, their earnings go up and down, and that's quite normal. So, example, if you think about any stocks that are very tied into, say, a specific price point. So, for example, let's say palm oil companies, right? I have plantation companies. So when it rains, it's quite normal to produce the same amount of crops, right? Typically, you may have some variations, but what will really determine whether you make a really bountiful harvest and you make a lot of money, or you make very little, is actually the price of CPO.
Yeah. Okay.
So if you have massive bountiful and everyone also got bountiful supply, and obviously the demand has been, it creeps up slowly over time, then obviously CPO prices will come down. Therefore your profits will come down, right? So you're going to see that kind of cyclical nature in these businesses.
I see.
And why you want to identify them very early on is because when you know they're cyclical, therefore you can very clearly define your strategy, right? So you won't be buying and holding this for the next 20 years and you go through all the cycles, right? If that makes sense.
Yeah. Okay, let's stop right there with just the 3 categories right now. We talk about investment grade, emerging grade and cyclical companies. I think we have a question previously from Lim Han Wei. He's asking, when you say these 6 categories, do we as an investor just focus on one particular category that suits how our investment style, or we should really just look at all these 6 categories when we find opportunities? What's your approach?
Okay, so not to be confused by, so we understand, as value investors, Buffett always talks about this. He talks about circle of competence, right? He says that you must buy a business that you do understand, right? So this is very different from the category of stock it is, because the category of stock actually defines your risk, right? So if say you like this business and you understand it really well, and say it's in investment grade, so you won't expect massive growth from these kind of investments, right?
Okay.
So as an investor, I would look at most categories. Probably the things that I do personally, I avoid. That's because of my risk assessment. I typically avoid startup,
right?
Which is number 6, and avoid sunset companies for obvious reasons, right? And these are the 2 major ones I avoid. And what I do allocate very little bit to are actually turnaround companies.
Right. Okay. Yeah, you mentioned about the next 3 categories, which is turnaround companies, sunset companies, and startup companies. But before we go more into detail in that 3 categories, why don't we start from investment grade? What is a type of company you say on Bursa right now that you see you deem it as an investment grade, and why do you deem it as an investment grade?
So one of the companies, I've been a long time investor in, actually since 2008, has actually been Nestle, right? Okay. So I'm not talking about pricing yet. I know it's gone up like crazy, right? When we first looked at it, it was $26, $28. That was that range, right? And it fell from $33 to $26. That was the lowest in the financial crisis. Now, but if you look at the business itself, Nestle is a very clear example of investment grade stock, right? It's been continuously profitable since it was listed on day one. So 24 years of continuous profits, and it's been paying dividends continuously for the last 24 years. Right? So when you have something like that, it almost creates a very clear predictability that, look, this year there's a very high likelihood, unless the business model changes dramatically, they're still going to make profits and they're still going to pay dividends. Right?
Okay.
Yeah, so Nestle will be one, but I'm not saying that it's necessarily very cheap right now.
Yeah, of course. These 6 categories are just a category of stock, but regardless of their valuation, we're talking about the business fundamentals of these stocks, right? That's what you're getting at. Okay, so Nestle is a good example of investment grade. If I can summarize, it's basically based on having a very long history of the company and long consistently growing and profitability, and of course having good dividends as well. So these are some of the things you look at. So for emerging grade, how would you categorize with an actual example? What kind of company do you see it as emerging grade, and why is it that case?
Yeah, so emerging grade would be a company where so it's one of the things that we have to be very clear about is that when we say we invest in a business, we need to understand the business, right? So a lot of times right now, especially we're seeing more and more companies being disrupted, right? In fact, not so much their products being disrupted, actually the way that's being done is being disrupted, right? The business model itself. So one of the emerging companies that I personally invested in is actually AirAsia. Right. AirAsia is very clearly in an emerging grade category. If you look at its counterpart, right? So in Malaysia, we've got our very famous airline that's been in business for more than 50 years, right? Of course, it's no longer listed; it was taken private, right? I'm talking about none other than Malaysian Airlines. They are both in the same sector. However, MAS, I would classify, if it was still listed, as right now either a turnaround or is trying very hard to turn around, or possibly in a sunset business, because they're both in the airline business, so they both ferry passengers, right? That's their business model. That's their business, but their business model is very, very different. So if you dig deep into the details, right, AirAsia only does 4-hour flights, very short haul, which means that their turnaround is fast, and they don't sell one seat per day. One seat equals to possibly 5 seats a day, right? Depending where to fly to. So their business model is vastly different, right? Very vastly different, and you're seeing the emergence of a very clear trend in Southeast Asia. More and more people has the propensity to travel, right? Or they want to travel. And especially short distances, the 4 hour is a very nice number. It's a very comfortable, you're not too long in a very uncomfortable seat. And you're willing to pay for that at a much lower price, right? So we're seeing that trend, and I personally believe that it's an emerging category that they're in.
Right. Okay. So a company that is in a maybe disrupting old industry, or in an industry that's still growing very rapidly. You talk about AirAsia. We have quite a number of investors from Singapore on our audience, and maybe. Yes, Malaysia Airline is no longer listed, but Singapore Airline is, right? So maybe we can talk a little bit about that one. I know you're not very familiar with the Singapore market, but Singapore Airline, basically, they have the traditional business Singapore Airline, but they also have a budget airline right now with Scoot. So it's a mix. When you see this kind of company, how do you categorize it? Can one company be in two categories at once? How do you look at it?
Oh, I think that's a very interesting question. I think clearly, if you look at where Singapore Airlines is, I think obviously this is not their first budget that they've started. This is after Tiger. This is what I would imagine their second time at it. Very clearly, they see the trend is there. Very clearly, they are trying to disrupt themselves.
Okay.
Right. They know that consumers. So one of the biggest things that you need to look for, especially when we talk about disruption, is actually consumer behavior.
Right.
This is all driven by consumer behavior, right? And if you look at them right now, what you need to first figure out is where would I put them under? But a large part of their business right now is still very traditional, right? In that sort of long haul premium segment.
Yes.
And Scoot is still very, very new, right? However, because they're a bit late in the game, they're going to be playing underdog for a while, right? Now, the reason is very simple. So when we look at companies, one of the things that at Equitiestracker is very important for us is to be data driven, right? So we need to look at the data. Because when AirAsia started more than 14 years ago, our CEO Tony has said that they were going to buy 100 Airbuses A320. Very early on, he already said that strategy. He put massive billboards. So if you guys come to KL, you can see those massive billboards. Well, more than 10 years ago, right? Today he's increased that number to 500, right? Now what has happened is that because he got the first mover advantage, he's basically almost bought up a main bulk of the capacity of the Airbus.
Right. Airbus
A3. So Scoot will have to play a serious catch-up game because from my last count, I think they only have 6 to 7 planes. AirAsia is close to about 200 planes, right? So it's going to be very difficult to get the same economies of scale. Plus, I think for Singapore Airlines, they still got a lot of legacy, right? So which is very high paid, premium, person sort of used to it. So the culture is vastly different, right? From what AirAsia from ground up, that was how it was built as low cost.
Okay. Maybe you're too kind to say it, but from your tone, it kind of see that you're not very optimistic about Singapore Airlines.
You know what? I won't be optimistic of any full fare airlines today.
Okay, that's fair enough. I like how you said that in Equitiestracker, you guys are data driven, and maybe for some of you who are not familiar with Equitiestracker, they are one of the largest financial educator provider and also data provider. I'll just put a link up right here on equitiestracker.com, you can see that they provide database for all the company listed on Singapore and also on Malaysia. So that's their website right now. You can see that I have the page of Nestle on, and the 10-year record of Nestle. So that's what Equitiestracker is doing. And going back to the next three categories, the turnaround, the sunset, and the startup, why don't we talk a little bit about the turnarounds? What kind of company is considered turnaround, and how do you look for turnaround in the stock market?
Now, turnaround companies are, probably my personal track record, of say about 4 that we've invested in. So turnaround basically are companies that have done really well. For some reason, they've come back down, right? So they've been disrupted, and they're trying to turn their business around. Yeah. My personal track record has not been fantastic for turnarounds. In fact, of the 4 that I picked, 3 have gone barely up, right? Okay. 1 is still waiting to turn around. Okay. Because it's very high risk, right? So when you look, so how do you look for them? They are typically companies that have done well before, but they've been disrupted, right? I mean, if you look at a very classic example, MAS today, after 5-6 years, is still trying to turn around. Yeah. So it's not easy. So it's a very momentous task to do major turnarounds. And it's probably a very high, I'll put it as a very, very high risk. But the ones that have turned around, especially in Malaysia, they've done really, when you get the right turnaround, you just got to hang on to them. Because once they've got that strategy right, it's all about execution. And if you can execute well, you're easily looking at 10-bagger, right? Right. Very multiple. So what we do is, we know there are 10-baggers potentially. So what we do is we allocate a very small percentage of portfolio, say example 1%. Right. Because if they do a 10-bagger, that's a 10% return, which is very good, right? But if they do turn around and they go belly up, even if you cut loss at 50%, you'll lose 0.5% of your portfolio.
Okay, fair enough. But can turnaround be a cyclical company as well? Because if we look at the oil and gas industry right now, they have seen their lows. Maybe if I want to buy into an oil and gas company, could I see it as a turnaround? What's the key difference between a turnaround in this case and a cyclical company?
I think that's a good question. So in Malaysia, right? So on the Bursa especially, so we've got so within the oil and gas industry, if you can see, a lot of them were hit extremely badly during 2015, right, when oil prices came crashing down. Of course, now it's inched back up. Now, but what happened during that 2-3 years? Some companies found it very difficult to sustain themselves, right? So in one particular one, we actually identified Dialog as an investment grade, but in a cyclical business. If that makes sense, right? So they've their profits were down, but even at the down period, they were still making money. So they were very clearly a cyclical business, because their business. So just to give you an idea, so a lot of the business models in the oil and gas industry, especially in Malaysia, they are all very contractual based. Right. Okay. So which means that I get a big job to build an oil rig or to build something and to supply. But their business is a bit, so they pivoted their business. It's 30% project based, 30% was basically in oil storage, which is right down neighborhood of Singapore, Pengerang. And that's a rental business, right? So whether oil prices go up or down, it doesn't really affect them that much, because it's still based on people are still using oil in a sense, so you need storage. And their 30% was actually maintenance, right? So 2/3 of their business was quite, in a way, not very badly, massively impacted, right? Because when oil prices came down, what happened was capex dramatically slowed down. So the companies that were in the capex business, they suffered a fair bit. So you need to look at their income streams or their revenue streams.
Right. Okay, okay. That's interesting. So you sort of mentioned, right, a company can be in two categories, like company like Dialog, both as a cyclical and also as an investment grade type of companies. Yeah, but moving on is sunset industry. I think this is more or less most people would understand. You know, you're talking about your traditional airline, maybe your media print type of companies, and maybe even a television company like Media Prima in Singapore. That's SPH. Would you agree that these kind of companies are considered like the sunset industry?
Yeah, absolutely right. Like what you mentioned, spot on. So like what I've said earlier about looking at consumer trends. People spend more time on their phones than they do with any sort of print media, right? And if you look at yourself, look at myself. First thing in the morning, you don't pick up newspapers, right? First thing you open your phone, you switch on, you get on the Facebook, you get on Twitter, and so on, right? Or any website. So in that sense, if you're purely only looking at numbers without that context, which is very important. So if you look at in Malaysia, so our equivalent of SPH would be, say, the Star newspaper, right? It did really well in the 90s, 2000, just probably peaked just before 2000, right? But if you look at the last 10 years, its revenue has been pretty much flat. It's got a lot of cash. It's almost got no debt. So it looks almost like your classic Benjamin Graham, buying $1 for 50 cents if you look at the balance sheet. But what is very important is that you need to. Right now, their business is in I would say in massive danger of decline. If there's no shift or pivot in their business strategies.
Right. Okay. So is this kind of companies that you will want to avoid, or would say you like a Benjamin Graham type of investor? Can you still find value in this kind of companies?
So I did that before, and it hasn't worked out really well because so just give an example. One of the companies that I think it was probably 5 years ago. What was in decline, and you look at consumer products, was actually hard disk drives. So in Malaysia, we've got 2 or 3 major guys that supply the hard disk industry. So when you look at the actual physical hard disk, it's something it's rotating. It's a mechanical thing, right? And if you go to buy laptops today, first of all, there was a massive decline in the PCs. So PC shipments were down, right? Tablets and laptops were on the way up, right? And if you look at a tablet or phone today, or even mobile phones, there's nothing mechanical inside it. It's all what they run on SSDs, right, for storage. So I invested in one company. I was hoping for it to turn around because it looked fantastic on the balance sheet, right? The balance sheet and assets were looking at like $1.20.
Wow. Okay.
And it was selling for say 40 cents, I think, at that point, right? So it looked fantastic, right? Of course, it recovered a little bit. It's come back down. So from that lesson, I was hoping that you go up, hard disk drives can go away. But we just got to be honest with ourselves sometimes and say, look, it was a bad call. And hope isn't data driven.
Yeah, definitely. I like that. I like that tagline. Okay. Wow. Okay. Our comment is filling up. Hi to Grace and Hirani. I'm sorry if I pronounce it wrongly. And we're going to talk about startup right now. This category. I think Hirani has a good question on it as well. So when you look at AirAsia, right, and when you look at AirAsia X, so would you consider AirAsia X as a startup? And AirAsia is an emerging grade. And what's the key difference between the two of them? And why one is in startup, one is in emerging?
I think that's a very good question. In fact, I've also invested in AirAsia X. So AirAsia X, as you know, was a spin-off from AirAsia, right? But both their business, although they carry almost the same name, their business models are very far apart. Why I say this is this, right? AirAsia X flies anything above 4 hours, right? So which means what straight away changes that business model? You got to start thinking, because we only have 24 hours a day. So I travel to Melbourne quite often, and I always take AHX as part of being a diligent value investor to make sure I know the business that's in, and I know what they do. And what I do is I always try and see their load factor. Now, even if they kept the load factor fairly high, and understand this is almost the first low cost long haul business.
Yep.
It's not proven, but the management seems to be very gung ho and positive about it. Whereas the short haul low cost model is proven, right? It's 40-50-year-old model from the US and Europe, right?
Yep.
So if you look at AHX, I would consider them a startup very early on. Number one, because they've only been listed for 5 years now, and I think right now where I would put them under is a turnaround category, because if you look at 2 years ago, they did a $450 million rights issue.
Yes.
Because they were very undercapitalized, and they installed a new CEO. Right, and very most recently, Tony Fernandez now is the CEO, right?
Yep.
And obviously, it needs a lot more care and attention to show or to prove that this model does work, right? The main difference is this. Say, example, if I only have 24 hours in a day, and I do an 8-hour flight, technically, if I do a fly there and I turn around, that's 16 hours, right? That's excluding any time I spend on the ground and any shift change I have to do, right? So really, if you look at it, I can only probably sell that one seat twice in a day.
Yep. Okay.
If we compare it to, say, AirAsia, and let's say I fly KL Singapore, which is an hour, right? Yep. If I fly for 15 hours a day, technically, if you think about it, I can sell that one seat about 10 times.
Yep. Okay.
Yeah. So you can see where the big difference is. So it's almost like a budget hotel model. Which is Singapore, which is I think like Fragrance or 99, right? Hotel 99. That's a budget hotel. Wait, well, 88. Sorry, 88. Where they do hourly rates, right? But
right.
That's really what it is, right? And versus a full-fledged premium hotel, where they don't do hourlies and they only do. So your capacity, say for a full-service hotel, let's say they have 500 rooms. In one day, they can only sell 500 rooms, right?
I see.
Where if you look at a budget hotel that's hourly example, they look at the business model, right? If they have 100 rooms, but if they can turn it over 5 times, they can be as big as capacity as a full service hotel.
Right. Okay. That's a good explanation. Yeah. Maybe now we go more deeply into specifics, right? I think Alex asked a question. What are some of the stocks you personally invested in, or maybe I can turn the question back to the 6th category. Which are the categories that you most focus in, and why, and maybe what are some of the companies that you consider it inside that category?
Okay, so when we talk about categories, how I look at it is really how to structure a portfolio.
Okay.
So, for example, let's say 100,000, or building $100,000 portfolio, depending on what kind of returns I'm looking for, right?
Okay.
So I give you some very extreme examples, right? If I'm looking for a 5, 7, 8% return portfolio, I would almost put almost everything into investment grade stocks.
Right. Okay.
Right, or maybe a 10% allocation for emerging grade.
Okay.
Right.
Okay.
But if I was saying, look, I'm trying to look for a 20-30% compounded return portfolio, which is even better than Buffett, by the way. Okay. I obviously need to take more risk, right? So an investment grade allocation would drop dramatically down to say maybe 20-30%.
Yep.
The rest will be spread out between your emerging grade, some startups, right? Some turnaround, hopefully not failing stocks, okay? And maybe some cyclical stocks. But if that makes sense to you, right? So it's about allocation of that category.
Okay. So you use the 6th category to sort of build your portfolio around it, right? That's a good way to do it. I think Grace is asking a question. When you say startup companies, are you just referring to their history as listed companies, or how do you define them?
That's a good question. I personally define them as when they get, look, say they were a 50-year-old company, and they just got listed. I always consider them a startup.
Ah, okay, okay. So,
Right? Why? Because I'm just a bit more prudent that way.
okay. Yep. Definitely. So startup are companies with less listing history. Right. Cool.
Right.
I think.
No, let me explain the reason why. Though.
Okay. Yeah.
The reason why is that when a company is private and public, they are both very different animals.
Okay.
Yeah.
Can you explain a little bit more why?
So, say if you're privately owned, you do whatever you really like to do, right? But when you become public, one big question is, how do I even know that this company is going to pay any dividends, for example? We don't know, right? Neither do we know if, they've been profitable before, but were they profitable before because management was underpaying themselves, and now they become public, they follow everything correctly. I mean, not to say follow everything correctly, but they go back to market rates, right? We don't know, right? So your best friend is really time, right? To really give you an idea of a track record. Yeah.
Cool. Okay, I understand now. Right. Because you never know how the management is going to behave as a private company and a public company.
Yeah. Right.
I like this question from Karina. I think she's very forward. She said, "Can you share your best stock idea today?"
Best stock.
or maybe put it in a better way. Is there a company that you recently bought into, and maybe you share with us your thought process on why you invest in that company?
Oh, okay. I have a few, so I don't know how much time we have.
We can just share one or two. Is okay.
So one of the companies that I recently bought into was actually this company called Globetronics.
Oh, okay. Globetronics, right?
Yeah. So why? Let me tell you the why, the process first. So I've been watching this company for a long time, and they fall very clearly. If you look at the data, they've been continuously profitable for the last 15 years. They've paid dividends every single year. They've got good management. They've got good balance flow. They've got cash flow. In fact, they have no debt, right? They're in a net cash position. So they've got a lot of cash versus their debt. So that's why I consider their net cash position.
Okay.
And because of Donald Trump recently, we got to thank him really because of this tariff war that they were going to have. So basically every single stock that were anything linked to technology or semiconductors got hit, right? Their price came down almost 50%.
Wow.
Yeah. If you look into what they do, they actually develop sensors, or they manufacture sensors. Okay. And if you look at consumer behavior today, more and more, your phone is, every new version has more and more sensors. Right? Just to give you an idea what a sensor would be like. So say example, a proximity sensor. You realize when you on your phone, the screen switches off. But then when you say, oh, I need to go and check something on my phone while I'm on the phone, and I put it that way, straight away the screen comes back on.
Yes.
So that is run by a sensor.
Right. Okay.
Right? So that stock price came down 50%. I thought it was absolutely irrational. Why? Market is irrational anyway, right? That's why we are value investors. And yeah, we started buying into this stock. Of course, we don't know where the bottom is going to be, so it get lower, we just average down.
Right.
And if you look at what the implications were, because everyone was afraid that all the tech stocks are all going to go, but if you ask me today, if Trump was going to install tariffs onto most of the electronics are manufactured in China, I think it's very clear on that. It would hurt them quite a bit if they had to pay more tax themselves on stuff that they need themselves, right? That was just one rationality. Now, so say that even that comes into effect, markets or businesses are quite smart in a way where they will just find new places they would export from. So if you look at massive bases outside of China with capacity for semiconductors, actually Malaysia is easily top 5, right? Yeah. Globally in terms of semiconductors. In fact, 50% of our exports is in semiconductors or electronics.
Electronics, yeah.
Right? It's bigger than oil palm and crude oil itself is double that of both combined. So you can imagine how big it is, right? So even if that comes into effect, manufacturers just move their base to where it already exists, right? So it's not easy to set up a hub for electronics, right? Because you need the people, right? You need engineers, you need the infrastructure, you need people with experience, right? You can't just pick a spot and say, yeah, let's start it here, and that's going to happen, right? You need port facilities, you need all that. Yep. And most of it is based up in Penang, in Malaysia itself. So I thought, look, even if that was going to happen, they may just have to export out of Malaysia, right? Because there's no tariff, right? And business people are smart, right? They figure out a way how to get around some of these loopholes.
Yes.
And if you look at consumer trends, people are demanding more and more electronics, and electronics have a lot of sensors in them. In fact, cars are the next big ones where massive components are getting to.
Definitely.
In fact, there's one stock that is in that space in Malaysia. It's called KESM.
Okay.
So it starts with so K for Korea, England, right? Singapore, Malaysia.
Okay. Yeah. I'll comment it down on the comment.
You can comment it down. In fact, the holding company is listed in Singapore, right? They're called Sunride. So that's a bit of both sides you guys can look at.
Okay, interesting.
But it's not a stock tip, but something that
definitely.
Yeah,
we are both not stock advisors, so do your own research before you buy any
stock. Not stock advisors. Yeah.
Okay, yeah, interesting. And I guess a lot of Malaysian investors right now is worried about the election, and I guess this question always comes up during election time. But maybe can you from your own analysis, how do you see if either side wins? What is the pros and cons, and what kind of companies could be affected in this case?
So one of the things that I personally avoid are any politically linked companies. Because I am politically party agnostic, right? So what happens that when you have political companies, typically they make a lot of money, or they lose, or they have no contracts, right? At a stroke of a pen. So that's a risk that or that I don't want to take, right? So at the risk of pen, either you become the next big thing, or you are nothing, right? So because of such major dependence, I typically avoid any politically linked stocks, right? Regardless on the result, the Malaysian economy is still very resilient, in my opinion. In fact, I gave an interview just end of last year, and I was, and everyone's a bit pessimistic on the Malaysian economy. In fact, the ringgit has strengthened quite a fair bit against the greenback. In fact, 2 years ago when we dropped to 440 or 450 to the greenback, that was really, in a way, if you ask me, it did not reflect the fundamentals of the economy. We still grow at least 5% a year, and because we always like to compare Malaysia and Singapore, right? But we are definitely at a much lower base, right? So it's a lot easier for us to grow 5%. To say where Singapore, you guys have a very strong economy, and to inch out that 5% growth is very tough.
Yep.
Okay. So we go to where the fishes are, it'll be easier to fish.
I like that. Okay. So basically, to avoid any risk, just avoid political linked stocks. Okay.
Yeah, because nothing's gonna happen. Say like Nestle, regardless on the elections, people are still going to be eating Maggi mee, drinking Milo, and life still goes on, right?
Yeah, definitely. Okay. Yeah. And maybe we talk a little bit about the market condition. Like I think since the beginning of last year, many people are talking like the market valuation is relatively high. I know the KLCI has come down a bit. But how do you gauge the valuation of the market, and how do you control your risk against that?
So basically, I guess the question is around market timing, right?
Yeah.
Okay, I think market timing is probably one of the most difficult things to predict. I try myself to avoid trying to predict markets. Why? Because I'm a long-term investor.
Mm-hmm.
Therefore, my portfolios at least last more than 5 years. So, once I put money in, it doesn't come out for at least 5 years. So we know that markets go up and down. I think, since the age of time, every investor has been trying to predict markets. They might get it right once, but I don't know anyone who's gotten the last 4 or 5 recessions to the T in terms of timing correct, right? So if you're running your own personal portfolio and you're invested over a long term, market timing should not that much weigh in on your decisions to invest, because we are looking at a bit more of a micro level where we're investing in individual companies.
Mm-hmm.
We know for a fact, if you want to be very safe, you can buy companies that have been around for a long time. And I mean, you look at Nestle's, right? It survived pretty much almost all prime ministers, all any major impact, right?
Yep.
Yes, in the short term, it may have been impacted the pricing, right? But that's only an opportunity. But in the long term, it will still continue to grow, right? So that's something that would be my answer in terms of market timing. I try to avoid putting a very big weightage on market timing.
Yep. I think our philosophy is very, very similar, and it's just buying good companies and hold it for the long term, right?
Yeah.
Thank you so much, Alvin, for your time. I think it's extremely valuable to many of our audience. Now, I believe that you guys have some free gift for our audience.
Yeah.
Maybe you want to spend some time to talk about what you're giving us.
Yeah, actually, thank you, Stanley, for having me, and all the audience for signing in today's what, a Thursday, right? Or Wednesday, on a Wednesday afternoon, right? Okay,
Yep.
Especially during lunch. So what we'd like to do is to give everyone access to Equitiestracker and to have a look at some of the data that you may need for investing. So I'm going to give everyone. So we're going to give you a link where you can just give us your name and your details, and we'll send you a login for free for 30 days. And that's only for readers of Value Invest Asia.
Wow, thank you so much, Alvin. Yeah, I'll share with you guys the link where you can sign up for it, and you get a free 30-day trial on Equitiestracker, and you get database, I think, for Singapore, Malaysia, and you guys even have starting the Australian database as well, right?
Yeah, right. Yeah.
Wow. Okay, that's perfect. I'll share the link down with you guys, and thank you so much, Alvin. I hope to have you on our show again soon.
Thanks, Stanley. Thank you very much. Thank you, everyone, for watching.
Yeah. Cheers.
Bye.